The United States dominates AI and software, but it has lost the manufacturing capacity to physically bring them to life. This is a fatal vulnerability. The US Navy is trapped in the worst bottleneck in its history, and NATO's arsenals are running dry. The defense manufacturing lines of the Western world have ground to a halt. While the AUKUS alliance between Australia and the US begins to show cracks, South Korea is stepping up for its own national defense with independent nuclear-powered submarines, while simultaneously building a cutting-edge SMR ecosystem. Wall Street's smart money is already making its move. Today, we will completely decode exactly which assets to hold during this massive paradigm shift. This is why smart investors are turning to South Korea. South Korean equities are capturing the attention of the entire world. In 2025, the Kospi surged by 75%, and the Kosdaq climbed 37%, recording the highest returns among all major global stock markets. And the momentum hasn't stopped. As of May 11th, 2026, the Kospi has posted an unprecedented year-to-date return of 80%. What is the secret behind this explosive rally in South Korean stocks? It comes down to two industries reshaping the global economy: AI semiconductors and the defense sector. South Korea stands at the absolute center of both as a manufacturing powerhouse. In today's video, we will analyze the macroeconomic environment driving the Korean market and present an actionable way to invest through the US-listed EWY ETF. First, South Korea is riding a massive AI supercycle. Big tech doesn't just exist on US exchanges. The South Korean market houses the critical semiconductor giants that make big tech possible. To seamlessly run AI tools like ChatGPT or Gemini, massive AI data centers are required. And those data centers run on HBM, high-bandwidth memory chips. Today, the only companies in the world capable of mass-producing HBM at scale are South Korea's Samsung Electronics and SK Hynix. The numbers speak for themselves. From the beginning of 2026 to May, Samsung's stock has soared over 130%, while SK Hynix has skyrocketed by more than 180%. As long as global AI infrastructure investment continues, the profit margins of these two giants are expected to be sustained, or even climb higher. Second, South Korea is rapidly expanding its defense exports, backed by unrivaled manufacturing competitiveness. Before February 2022, many NATO members enjoyed a peace dividend, slashing defense budgets for decades. The invasion ended that overnight. European nations suddenly needed to rearm, and fast. The critical question was, who could deliver artillery, armored vehicles, and advanced military systems at an industrial scale, at competitive prices, and strictly on schedule? The answer, repeatedly, has been South Korea. The Korean defense industry has secured multi-billion-dollar contracts with nations like Poland, Romania, and Norway. K-2 tanks, K-9 self-propelled howitzers, and F-A-50 light combat aircraft are now staple equipment for European militaries. South Korea is no longer just a regional buyer, it has become a premier global defense exporter. Simultaneously, the global energy transition has triggered a shipbuilding boom dominated by South Korea. LNG carriers, highly complex vessels transporting liquefied natural gas across oceans, require a level of engineering precision achieved by only a handful of companies globally. HD Hyundai, Hanwha Ocean, and Samsung Heavy Industries are sweeping the majority of global LNG carrier orders. This is geopolitics translating directly into revenue. And unlike the semiconductor cycle, the defense and shipbuilding cycles are driven by long-term government procurement programs, meaning they tend to flow in 10-year supercycles rather than single-year spikes. Third, the brand value of South Korean corporations is at an all-time high. Companies like Samsung Electronics, Hyundai, Kia, and LG have transitioned from being fast followers to global premium brands deeply familiar to consumers. This continuous elevation in brand value translates directly into higher margins and consequently higher stock prices. Fourth, we are witnessing the death of the Korea discount. In July 2025, South Korea passed a landmark amendment to its Commercial Act, legally mandating that corporate directors act in the interest of all shareholders, not just the controlling families or chaebols. Treasury stocks, once hoarded to maintain family control, must now be cancelled. The influence of controlling families has been further restricted by a 3% voting rights limit when appointing audit committee members. The result? The structural discount that plagued Korean equities for decades is finally lifting, and foreign capital is flooding back into the market. Finally, South Korea has achieved remarkable political stability. The nation swiftly and democratically overcame the illegal martial law crisis of the previous administration. Under President Lee Jae-myung, South Korea has restored institutional trust in its liberal democracy. By resolving political uncertainty through a peaceful transition of power, it provided immense relief to global capital markets. Today, South Korea's CDS premiums are at their lowest levels, signifying a drastic reduction in geopolitical country risk. So, how can you actually invest in everything we've just discussed? For most foreign investors, especially those in North America, the simplest answer is a single ETF, EWY, the iShares MSCI South Korea ETF issued by BlackRock. What makes EWY so compelling and simultaneously concentrated is its holding structure. The top two holdings are SK Hynix at approximately 25% and Samsung Electronics at 24%. Combined, they make up nearly half of the entire fund. Buying EWY is essentially placing a massive bet on the AI memory semiconductor thesis, bundled with broader exposure to the Korean market, including Hyundai, Hanwha Aerospace, Doosan Enerbility, and Korean financials. For investors who want even more concentrated semiconductor exposure, a new ETF launched in April 2026, ticker DRAM, holds Samsung, SK Hynix, and Micron in roughly equal weights. Think of EWY as the full Korean buffet. DRAM is a concentrated single bet on memory. Even with this explosive growth, the EWY ETF remains deeply undervalued compared to the QQQ or SPY when looking at key metrics like the price to earnings, P/E, and price to book, P/B ratios. But what are the risks you need to know? First, concentration risk. With nearly half the fund in two stocks, any slowdown in HBM demand or missteps in Samsung's foundry business will directly hit the ETF. Second, currency risk. EWY holds won-denominated assets, meaning the USD to KRW exchange rate will impact your returns. The Korean won can be volatile. Third, geopolitical risk. North Korea remains a constant risk premium priced into South Korean assets. Fourth, valuation risk. After a 120% rally over the past year, you are no longer buying at the absolute bottom. Corporate earnings must now catch up to these valuations. Here is my view. EWY is the single most efficient ticker to simultaneously express three major theses: the AI infrastructure cycle, Korean corporate governance reform, and global defense expansion. The Korea discount is ending. AI semiconductors, defense exports, global brand prestige, governance reform, and political stability. These five structural forces are converging simultaneously for the first time in South Korean stock market history. EWWI is the simplest vehicle to access this historic inflection point. Look at the global markets right now. Everyone is fixated on the AI boom. When foreign investors look at South Korea, the crowd is hyper-focused on generic tech ETFs like EWY and the semiconductor cycle. But while the masses are staring at silicon chips, the smart money is quietly accumulating something much heavier: defense. Welcome back to the Kairos, where we decode the flows of the global macroeconomy. Today we are talking about a paradigm shift into what Ray Dalio calls a war economy. In this new world order, the true backbone sustaining the South Korean economy is the defense industry. By the end of this video, you will understand exactly why South Korea has become the arsenal of democracy, dominating land, sea, and air. And most importantly, we will reveal exactly why the KDEF ETF offers an overwhelmingly high investment appeal right now, easily rivaling traditional US defense ETFs like ITA or SHLD. To understand the K-defense boom, we must first look at the vulnerabilities of the Western world. The reality is that the West's arsenals and manufacturing capabilities have hit rock bottom. After undergoing de-industrialization for the past 30 years, NATO realized that their production lines were completely frozen the moment a massive land war broke out. It literally takes years for massive Western defense contractors to deliver new artillery. But this crisis isn't just limited to the land. Currently, the US Navy is facing the worst bottleneck in its history. America's aging shipyards are struggling to even maintain their existing fleets, let alone build new warships fast enough to counter the rising threats in the Pacific. But in the midst of this geopolitical panic, there was one nation perfectly prepared: South Korea. Because South Korea never shut down its defense manufacturing lines, it has become the global gold standard for speed, scale, and reliability in the ground weapons market. The K9 Thunder, which now commands half of the global self-propelled howitzer market, and the K2 Black Panther tank sweeping across Europe are the ultimate proof. But it doesn't stop there. The FA-50 light combat aircraft is actively being exported to Asia, South America, and Europe. And the Cheonggung-2 missile defense system, having proven its performance and secured massive deals in the Middle East, has become the top priority acquisition for major nations worldwide. The next massive supercycle is currently unfolding in the sky and at sea. The KF-21 next-generation fighter jet has successfully completed its development phase and is throwing down the gauntlet in the global export market. Simultaneously, South Korea's overwhelming prowess in shipbuilding is translating directly into naval dominance. Korean-built frigates and offshore patrol vessels have been exported to various nations, including the Philippines and Peru, securing vital maritime choke points. However, the true wealth in the defense industry comes from MRO, maintenance, repair, and overhaul. And right now, history is being written on the ocean. Due to the severe shortage of US shipbuilding capacity, the US Navy has officially begun outsourcing the MRO of its naval vessels to South Korean shipyards. The greatest naval force in history is now relying on South Korean infrastructure to maintain its combat readiness. This is an unprecedented structural shift. On top of this, let's talk about Canada. The Royal Canadian Navy is currently accelerating the Canadian Patrol Submarine Project, CPSP, to acquire up to 12 new submarines to protect its massive coastlines and the Arctic. South Korean maritime titans are currently the absolute frontrunners. They are pitching the KSS-3 class submarines, which feature advanced air-independent propulsion, AIP, for extended underwater endurance. But the real reason Korea is winning: they are the only ones who can actually deliver these 3,000-ton submarines on Ottawa's urgent timeline. Furthermore, the South Korean government is drawing the blueprint for the introduction of nuclear-powered submarines. This technological leap will permanently cement South Korea as a global naval defense superpower. Now, let's ask the most important question. If the entire world is rearming, shouldn't you just buy traditional US defense ETFs like ITA or SHLD, which hold great companies like Lockheed Martin and General Dynamics? The reason the smart money is pivoting to KDEF is clear. It all comes down to the difference in execution and valuation. When you buy ITA or SHLD, you're buying into companies trapped in a fundamental bottleneck. Yes, they have massive order backlogs, but they suffer from extreme labor shortages and broken supply chains. They lack the physical capacity to quickly convert orders into revenue. Ultimately, investors are forced to pay a high premium, a high PE ratio, to giant corporations that take 5 to 10 years to actually deliver the weapons. In stark contrast, KDEF's core competitive edge is speed to market. Because South Korea possesses active, immediately operational production lines, the estimated $78 billion order backlog amassed by K-defense firms translates directly into explosive earnings growth today, not in the distant future. Korean companies are seamlessly absorbing the market vacuum in Europe and the Middle East, created by the slow pace of US defense contractors. Therefore, KDEF offers significantly higher growth velocity, crystal clear earnings visibility, and a much more attractive valuation compared to the heavy traditional US defense ETFs. So, how can you capture this macro trend in your portfolio? The Plus KDEF ETF is a pure play defense ETF that tracks the core powerhouse companies of the defense industry. With this single ticker, you can instantly invest in the giants of defense. You capture Hanwha Aerospace and Hyundai Rotem dominating the land wars, and Lignex's one leading missile defense. At the same time, you gain exposure to the maritime titans, Hanwha Ocean and HD Hyundai Heavy Industries, the very companies winning US Navy MRO contracts and building the next generation of warships and submarines. KDEF is not just a simple Korean ETF. It is a direct solution to the manufacturing crisis in the Western world and the ultimate geopolitical hedging index. In this new world order, nations must arm themselves, and South Korea stands as the supreme weapons supplier encompassing land, sea, and air. While the masses bet everything on consumer tech stocks, make sure your portfolio is equipped with the strongest shield. As the changing world order accelerates and the Thucydides trap tightens around US-China relations, the geopolitical center of gravity has shifted entirely to the Indo-Pacific. Today, we are looking at a massive game changer: South Korea's indigenous nuclear-powered submarine project, the KSSN. This isn't just a localized containment strategy. The ripple effects of the KSSN span across the entire geopolitical chessboard. For Washington, a self-reliant South Korea eases the operational strain on an overwhelmed US naval industry. For Ottawa, currently searching for its next-generation fleet to secure its frozen northern borders, Seoul provides a textbook case of strategic agility. And for regional anchors like New Delhi and Manila, facing constant maritime friction, a robust South Korean blue water navy acts as an indispensable counterweight. Welcome back to the Kairos, where we decode the intersection of global macroeconomics and economic security. Today we'll unpack the strategic calculus and the technical leap behind the KSSN, contrast it with the increasingly fragile AUKUS alliance, and analyze what this means for the global defense supercycle and the new nuclear renaissance. Let's start with the hardware. South Korea currently operates a highly capable fleet of diesel-electric submarines, culminating in the 3,000-ton Dosan An Chang-ho class, KSS-3. They are engineering marvels, but they suffer from a fatal flaw inherent to all conventional subs: the need to snorkel. To recharge their batteries, they must surface or come to periscope depth, exposing themselves to advanced enemy radar and sonar. The KSSN project fundamentally changes this paradigm. We are looking at a jump to a 5,000-ton class or larger vessel. Why the massive increase in size? It's not just to fit a pressurized water reactor. A larger hull means a significantly expanded vertical launch system, VLS. While current diesel subs can carry a limited number of submarine-launched ballistic missiles, SLBMs, the KSSN will be a heavily armed arsenal ship. It provides a devastating, survivable second strike capability. To continuously track adversary SLBM submarines from the moment they leave port, 24/7 submerged capability is non-negotiable. A nuclear submarine can operate at top speed for months without surfacing, limited only by the food supply for its crew. But there is another critical frontier: the Arctic Ocean. As global warming opens new polar sea routes, The ability to operate silently under thick ice sheets is the ultimate strategic advantage. Diesel subs simply cannot survive under the ice because they cannot surface to breathe. For nations like Canada, struggling to secure its Arctic sovereignty against Russian and Chinese expansion, this under-ice capability of a nuclear submarine is the holy grail of maritime security. For South Korea, it secures the broadest possible sea lines of communication, transforming its fleet from a coastal defense force into a true blue water navy capable of protecting global trade routes. Of course, the primary bottleneck for the KSSN has always been the political and technical hurdle of nuclear fuel. The US and the UK use highly enriched uranium, HEU, weapons-grade material enriched to over 90%. This allows their submarines to run for 30 years without refueling. But South Korea, bound by strict international non-proliferation frameworks and bilateral agreements with Washington, needed a different path. Enter France. France's latest Suffren-class nuclear submarines run on low-enriched uranium, LEU, enriched to under 20%. The operational trade-off is that an LEU reactor needs to be refueled every 7 to 10 years, but strategically it provides a massive loophole. By adopting an LEU model and securing fuel from French state-owned entities, South Korea perfectly satisfies the global non-proliferation regime while achieving its military objectives. It's a geopolitical masterstroke. Seoul traded its potential support for French maritime security initiatives for a secure, independent nuclear supply chain. A brilliant Plan B. And this leverage is already working. Breaking news indicates that a US working-level delegation on nuclear issues is urgently heading to Seoul. Washington has realized that with the French alternative actively on the table, it cannot afford to sideline or dictate terms to its most capable Indo-Pacific ally. This multi-track diplomacy maximizes Seoul's negotiating power, proving that technological independence is the root of diplomatic leverage. To truly understand the brilliance of South Korea's strategy, look at the cracks forming in the AUKUS alliance. Australia chose total reliance on the US and UK for its nuclear submarine capabilities. They essentially outsourced their sovereign defense infrastructure. The result? The US shipbuilding industry is facing a severe systemic bottleneck. Plagued by labor shortages and supply chain disruptions, US shipyards are struggling to meet even their own domestic production targets for the Virginia-class submarines. Consequently, the delivery of subs to Australia is slipping further into the late 2030s. Australia is now facing a catastrophic capability gap, forced to pour billions of dollars into life-extending obsolete diesel subs just to maintain a minimal presence. South Korea is taking the exact opposite approach. Leveraging its world-class commercial and naval shipbuilding infrastructure, domestic defense giants are designing and building the hull and the miniaturized reactor entirely locally. By importing only the fuel from abroad, South Korea insulates itself from the political gridlock and industrial failures of allied supply chains. This is what true national resilience looks like. Finally, let's tie this massive geopolitical shift directly to our portfolios. The KSSN project is a multi-decade catalyst for the South Korean shipbuilding and defense sectors. Furthermore, this military innovation intersects directly with the AI-driven nuclear renaissance. The ultra-safe, highly compact reactors required for these submarines share the exact same DNA as commercial small modular reactors, SMRs. As tech giants desperately seek baseline power for their massive AI data centers, the SMR market is projected to reach hundreds of billions of dollars. If South Korea successfully domesticates and stress tests the KSSN reactor at sea, it positions itself as a dominant Tier 1 player in the global SMR market, directly challenging Russian and Chinese dominance in next-generation energy infrastructure. The KSSN is not just a submarine. It's a grand strategy. It represents a masterclass in navigating the Thucydides trap, balancing alliances, securing energy independence, projecting power into the deep ocean, and positioning domestic industries at the forefront of the defense and SMR supercycles. As institutional capital flows into these sectors, the South Korean defense supply chain is no longer just an emerging market tactical play. It has become a core strategic allocation for the new world order. In the modern global economy, the United States stands as the ultimate apex predator. It commands the intellectual architecture of artificial intelligence, holds an absolute monopoly over global software ecosystems, and wields the US dollar as an unparalleled weapon of financial hegemony. Yet, beneath this glittering canopy of digital supremacy lies a massive structural vulnerability. Silicon Valley can design the most advanced algorithms in human history, but it cannot physically build the infrastructure required to sustain them. Over the past 4 decades, the material foundation of the Western world, heavy manufacturing, advanced hardware engineering, precision grid infrastructure, and naval shipbuilding, has been systematically hollowed out. Now, as the geopolitical rivalry between Washington and Beijing transitions from a cold trade dispute into an absolute battle for supply chain survival, America faces a terrifying realization. It has lost the physical puzzle pieces required to anchor its global dominance. For years, global capital markets ignored this physical deficit, assuming that open markets and offshore manufacturing would indefinitely supply cheap goods. But that illusion has shattered. The South China Sea has transformed from a commercial highway into a volatile geopolitical fault line. The West can no longer outsource its critical hardware to nations that may pose a direct threat to its long-term security. The global supply chain is fracturing along ideological lines. This is not a temporary disruption. It is a permanent rewiring of global macroeconomics. The United States desperately needs a manufacturing core alliance, a group of highly advanced, ideologically aligned partners capable of producing high-end hardware at an unmatchable scale. And to understand where the smart money is moving to capture this monumental shift, we must look at an unprecedented financial migration unfolding across the Pacific. Welcome back to the Kairos, where we decode the flow of global macroeconomics and track the smart money. Recently, the Financial Times highlighted a jaw-dropping phenomenon taking place in the South Korean capital markets. Driven by an insatiable global demand for artificial intelligence hardware, the Korean Kospi index experienced an extraordinary 18-month surge, multiplying its value and outpacing the historical trajectory of the late 1990s Nasdaq.com boom by nearly 6 months. This historic rally was not fueled by speculative retail mania, but by massive, calculated inflows of global institutional capital. Tech titans like Samsung Electronics and SK Hynix saw their valuations skyrocket by over 130% and 170% respectively, effectively carrying the entire index on their shoulders. Wall Street has realized that while America owns the software of the future, South Korea owns the physical factories capable of printing that future onto silicon. However, this dramatic index explosion exposed a profound paradox within the financial markets: extreme valuation polarity. While global capital concentrated heavily into Korea's technology behemoths, the broader domestic manufacturing base remained deeply, inexplicably discounted. Even amidst this historic AI supercycle, the forward price-to-earnings ratio of the Korean market hovered at an astonishingly low 8.6 times, compared to the rich 21.2 times multiplier of the US S&P 500. This stark divergence represents one of the largest valuation arbitrage opportunities in modern financial history. Recognizing this anomaly, the South Korean government launched its aggressive Corporate Value Up program, a sweeping structural reform designed to eliminate the historical discount and unlock shareholder value across its industrial champions. For sophisticated global investors, the conclusion became obvious. The traditional passive broad market indices are no longer sufficient. To capture the true manufacturing renaissance, capital required a highly targeted vehicle. This brings us to the ultimate strategic investment thesis of this macro cycle. Recently listed on the New York Stock Exchange under the ticker KMCA, the Plus Korea Manufacturing Core Alliance Index ETF represents a paradigm shift in thematic investing. KMCA does not blindly buy the entire Korean market. Instead, it operates as a precise filter, isolating the exact manufacturing core alliance that the Western supply chain desperately requires. It strips away the underperforming legacy sectors and concentrates capital exclusively into the industrial titans dominating the global hardware supercycle. By analyzing the underlying mechanics of KMCA, we uncover the three critical industrial pillars that make this portfolio an indispensable asset for the New World Order. The first foundational pillar of the KMCA portfolio is the advanced AI hardware and semiconductor supply chain. The world is beginning to understand that artificial intelligence software is entirely bottlenecked by physical memory limits. An advanced AI accelerator from NVIDIA is practically useless without high bandwidth memory, or HBM, capable of transferring massive datasets at lightning-fast speeds. KMCA concentrates heavily on SK Hynix and its core equipment suppliers, such as Hanmi Semiconductor. These companies do not merely compete in the global semiconductor landscape. They hold a functional monopoly over the generation of HBM3E and next-generation memory architectures. As large language models expand exponentially, the demand for this specialized hardware is decoupled from traditional consumer electronics cycles. KMCA isolates this high-margin, high-growth core, giving investors direct exposure to the material backbone of the digital age. The second vital pillar within KMCA is the unprecedented synergy between advanced defense manufacturing and naval shipbuilding. As we highlighted in our previous deep dive on Indo-Pacific geopolitics, the United States Navy faces a severe crisis. Its domestic shipyards are paralyzed by massive backlogs and labor shortages, making it impossible to build or repair combat vessels at the pace required to match regional expansion. To resolve this, Washington is leaning heavily on South Korea's maritime industrial complex. Korean shipbuilders maintain an unmatchable global reputation for delivering complex guided missile frigates, corvettes, and commercial vessels ahead of schedule and under budget. Furthermore, Korea's defense giants have become the de facto arsenal of democracy, exporting advanced F-A-50 fighter jets, K-2 tanks, and precision artillery to nations spanning from Eastern Europe to the Philippines. KMCA captures this defense supercycle, turning geopolitical tension into structural portfolio resilience. The third and perhaps most overlooked pillar of the KMCA thesis is the global power infrastructure and nuclear energy boom. The exponential rise of hyperscale AI data centers has triggered an unprecedented surge in global electricity demand. The world is facing an energy trilemma. It requires massive power, absolute reliability, and zero carbon emissions. To build this future, the Western world must completely overhaul its crumbling electrical grids and transition toward next-generation nuclear power, including small modular reactors or SMRs. This infrastructure supercycle requires an immense volume of ultra-high voltage transformers, substations, and reactor components. KMCA holds a dominant concentration in the precise industrial conglomerates, such as HD Hyundai Electric and LS Electric, that are sweeping up multi-billion-dollar grid modernization contracts across North America and Europe. This guarantees that KMCA investors are directly positioned to capture the massive capital expenditure flowing into the global energy transition. When you synthesize these three pillars, you realize that the KMCA ETF represents the intersection of three irresistible macroeconomic forces: friendshoring, valuation arbitrage, and structural industrial growth. Wall Street is recognizing that this is not just a standard thematic index. It is an economic security alliance packaged into a liquid, tradable vehicle. By stripping away legacy sectors and focusing entirely on the core manufacturing champions, KMCA allows global capital to bypass broad market volatility while gaining pure exposure to the physical architecture of the next decade. As the Korean government's Corporate Value Up program continuously forces structural corporate re-ratings, the historic discount at 8.6 times PE is destined to close. The smart money is not waiting for the fog to clear. It is actively rotating into the hard assets that underpin global power. Ultimately, the global economy is transitioning away from the purely digital, borderless illusions of the past 20 years. We have re-entered an era where physical manufacturing capacity, supply chain resilience, and sovereign defense technology dictate the wealth and security of nations. South Korea has established itself as the indispensable manufacturing core of the free world, the missing puzzle piece that the Western alliance cannot survive without. And through the KMCA ETF, global investors now possess the precise tool to deploy capital alongside this grand geopolitical shift. How do you view this massive capital migration into the manufacturing alliance? Is your portfolio prepared for the hard asset renaissance? Share your analysis in the comments below. If you want to navigate these complex macro trends and protect your wealth across changing cycles, make sure to subscribe to the Kairos. Until next time, invest smart, stay vigilant, and be prepared. Thank you.